Many people avoid investing, not because they do not understand it, but because they feel uncertain, and that uncertainty creates hesitation. It is a soft kind of fear, quiet but persistent. It lingers in the background of our financial lives, delaying first steps. For many, this hesitation becomes the reason wealth building never starts. Potential growth gets locked away in the name of comfort. Money touches almost every part of modern life: our jobs, our homes, our families, and our dreams for the future. Because it matters so much, safety comes first. Safety feels calm and predictable. It feels sure. A steady paycheck provides a number you can plan around. It helps you sleep a little easier. This is a human need, not a flaw. Investing, however, asks us to accept change and that discomfort. Markets move, values go up, and sometimes they go down. Stocks, bonds, and real estate can go up, a pleasant experience, but they can also go down, and that hurts. This movement is the engine of potential growth. Our brains are hardwired to scan for risk. When savings drop in value, the instinct is to retreat. Retreat is not weakness. It is a logical response to perceived threat. But the threat is often misunderstood. We fixate on short-term volatility and ignore slow, long-term dangers like inflation. A savings balance can rise while purchasing power falls. Quiet hesitation prioritizes present comfort over future well-being. It makes sense in the moment, but compounds into regret. Fear strongly influences behavior, especially with money. Understanding the fear is the beginning of better decisions. We do not eliminate uncertainty. We learn to live with it. And over time, we can reduce its influence on our actions. This is the psychology of money at work. A powerful reason people fear investing is loss aversion. It is simple but profound. Losing $100 feels heavy, while gaining $100 feels lighter and fleeting. The emotional impact is not symmetrical, so we pass on reasonable chances to grow. We favor what feels totally safe, even at the cost of growth. Imagine a coin toss. Heads, you win $150. Tails, you lose $100. Statistically, it is a great bet to repeat. Yet many refuse to play even once. The pain of losing overshadows larger potential gains. We focus on the downside and undervalue the upside. During downturns, loss aversion pushes selling at lows. Relief today can lock in permanent loss. Recognize it. This bias is human, not a personal failing. Create rules. Check less. Re-anchor to long-term goals. People have a deep need for certainty. Predictable paths once meant survival. Today, a steady paycheck is that path. It lets you plan with confidence. Investing shatters the illusion of certainty. The future feels fuzzy, even with charts and projections. So, the comfort of a savings account is alluring. We accept low, even negative real returns for predictability. Guarantee products sell a simple story: safety. But high fees and lower growth are the hidden price. Some upside, no scary downside. Comforting, yet costly over decades. True security comes from navigation, not avoidance. Build a plan robust enough for volatility. Trust a sound process more than outcomes. Confidence can be quiet. Preparedness over prophecy. We cannot control markets. We can control behavior. Emotions, not spreadsheets, often drive money choices. When markets fall, fear spreads. It can feel like the world is ending. People sell to make the danger stop. Relief arrives, but at a cost. Temporary downturn becomes a permanent loss. When markets rise, euphoria and FOMO take over. People jump in after big run-ups. Fear and greed, ping-pong behaviors. Sell low from fear. Hesitate. Miss the rebound. Opportunity departs while doubt lingers. A simple written plan separates emotions from actions. Pre-decide. Invest a set amount every month. Commit. Review at thresholds. Do not panic sell. A plan is a rational voice in turmoil. It keeps you aligned with long-term strategy. Avoiding investing can feel safest today. Seeing money feels secure. But that can be an illusion. There is a hidden cost, Slow erosion. Inflation raises prices over time. A dollar buys less every decade. Low-interest savings often lose real value. 3% minus 1% equals 2% purchasing power. Headlines ignore it. It is quiet. Missing growth is costly too. Over time, diversified portfolios have outpaced inflation, not guaranteed. Small, steady returns compound into large sums. Choosing comfort today can cost freedom tomorrow. A home delayed, retirement postponed, support constrained. Unseen loss is as real as a market loss. Reframe: visible volatility versus invisible erosion. Recognizing this cost is crucial. Many build wealth not through genius but behavior. They do not erase fear. They act despite it. They expect volatility and are not derailed when it arrives. They build around a long-term plan. Bad days and years become small blips across decades. Patience is a tool. Investing is like planting a sapling. You do not uproot to check the roots. You water, provide sunlight, and let time work. Losses happen. The response matters. They stay the course and follow the plan. They save regularly and invest systematically. Sometimes they buy more when prices are lower. Over years, steady beats frantic cleverness. They automate, keep costs low, and ignore noise. Success rests on thousands of unremarkable choices. Consistency is a superpower. Find a reasonable strategy and stick with it for a very long time. Separate risk from uncertainty. Risk is visible and partly measurable. We can plan for known ranges. Uncertainty is the truly unknown. A pandemic, a breakthrough, a surprise crisis. Uncertainty cannot be modeled. Build resilience into your plan. You do not need a crystal ball, just principles. Diversify across assets, industries, and geographies. Do not let one outcome decide your fate. Use time. Invest steadily over long periods. Dollar-cost averaging helps avoid timing traps. You buy more when prices are low, fewer when high. Time turns short-term volatility into long-term progress. Manage what you can. Behavior and process. Principles over predictions. Confidence grows from small steps. Learn slowly. One clear topic at a time. You do not need to master everything. Start incredibly small, even trivial. Feel the fluctuation, and see life continue. Write a simple plan. Decide what you will do when emotions rise. Use time. Automate contributions. Time does the heavy lifting. Start as early as you can. If late, start anyway. Add small doses of understanding weekly. Talk to someone who explains without hype. You do not need to predict the future to prepare for it. Manage your actions in the present. Small steps, practical knowledge, steady habits open the door to growth. Trust that calm choices, repeated, create peace of mind. In the end, behavior shapes outcomes. Steady habits often beat superior intelligence. Calm choices compound. Noise chasing rarely wins over decades. The goal is not to erase fear. Fear can be useful, a signal, not a stop sign. Understand why you are afraid. Name the drivers: loss aversion, need for certainty, the crowd. Build guardrails, rules and systems. Follow the plan over the impulse. If you feel hesitation, start small. Keep going. Money is a tool. Your behavior wields it. How you think and feel shapes what you can do. Small steps, repeated, become transformation. Many financial outcomes come from behavior, not knowledge. The difference between avoiding risk and managing risk can define long-term results.